Okay, let's unpack this. We're diving deep into insurance today. You've given us, well, a fantastic stack of sources, and our job is to pull out the really vital stuff, those aha moments about its history, its core ideas, make it all clearer.
Exactly. Insurance, really, it's about handling uncertainty, isn't it? We'll look at how people, societies have dealt with risk over time and why these basic concepts, well, they're essential for you today.
Right, so let's start at the beginning. Maybe, surprisingly, London coffee houses, Edward Lloyd's late 1600s.
Oh, definitely. It's amazing, really. That coffee house became the place. Ship owners, merchants, the folks taking on the risk, they all met there. Marine insurance, mostly.
A real marketplace for uncertainty, wow.
Yeah.
And that history, it's not the same everywhere. You mentioned Bangladesh, quite a different path there.
Yeah, very different from lots of private companies under British rule, then nationalization in 72, creating Sadharan Bima and Jiban Bima corporations, and then bringing the private sector back in from 84. A lot of change, fast.
That's fascinating. Okay, here's something that always seems to cause confusion. Insurance versus assurance. What's the real difference? Why does it matter for you?
Good question. It really boils down to indemnity versus a fixed sum. Insurance, think car, home, and indemnifies. The goal is to put you back, financially, where you were before the loss, compensating the loss.
Okay, so it makes you whole again, sort of.
Sort of, yes. Assurance, though, that's different, like life insurance or personal accident cover. It pays a fixed amount, an agreed sum, because, you can't really put a price on a life or a limb. So it's not indemnity, it's a pre-agreed payout for an event that, well, will happen eventually in the case of life assurance.
Ah, that makes sense. Indemnity versus fixed sum. Got it. Now, risk itself, we define it as
Yeah.
what a probable disadvantageous outcome from something unexpected.
That's the core, yes. And you look at two things, risk frequency, how often it might happen, and risk severity, how much it costs when it does happen.
Frequency and severity, right? And sometimes they're linked in ways you wouldn't expect, like the Heinrich triangle.
Exactly. That's a great example from industry. You might have, say, one major injury, but that's often linked to maybe 30 minor ones, and perhaps 300 incidents where nothing got damaged or hurt, near misses. Looking at the frequent, low-cost stuff can help prevent the rare, really costly events.
Interesting. So managing these risks, lots of ways to do it, but insurance is mainly about one method.
Primarily, yes. It's risk transfer. You pay a premium, and the insurer takes on the financial risk. They agree to cover the cost if the bad thing happens. That's the essence of it.
And they can do that because of the law of large numbers.
Precisely. An insurer can't know what will happen to you specifically. But if they insure thousands or millions of similar risks, say houses or lives of a certain age group, they can use statistics to predict the overall number of losses quite accurately. The more people, the better the prediction. Makes the whole thing work financially.
That statistical foundation is critical. Okay, let's switch to the legal side. Contracts, insurance versus just betting. Why is one a proper contract and the other isn't?
It comes back to two things. Indemnity, which we talked about, and insurable interest. You need a real legal financial stake in the thing you're insuring. You benefit if it's safe. You lose out if it's damaged or lost.
So you can't just insure your neighbor's house hoping it burns down.
Exactly. That would be a wager, not insurance. No insurable interest. That makes a contract void. Insurance requires that connection. You stand to lose financially.
Okay, makes sense. You have to have that interest. But when do you need it? Does it have to be there all the time?
Good point. It varies. For marine insurance, usually at the time of the loss, the claim. For fire, accident insurance, you generally need it when you take the policy and when you make a claim. Life insurance is different again. Typically, you only need the insurable interest right at the start when the policy begins.
Right, right. Different rules for different types. That's clear. And sticking with principles. Contribution. This falls from indemnity too, doesn't it? Stops you profiting from a loss.
Absolutely. It's a corollary to indemnity, as they say. Prevents you claiming the full amount from, say, two different policies for the same fire damage. For it to apply, though, certain conditions must be met. It has to be.
Multiple policies.
Yes, multiple policies covering the same subject matter against the same peril, protecting the same interest, and for the same insured person or entity. If all that matches up, the insurers share the payout proportionally.
Stops double dipping. Makes sense. But then you have valued policies. You said they were a departure from indemnity. How so?
Yeah, they are a bit different. With a valued policy, you and the insurer agree on the value of the item, maybe a piece of part or an antique car right at the start. That value is written into the policy. If it's destroyed, that's the amount paid out, even if the market value has changed. So it's not strictly about the actual financial loss at the time, but that pre-agreed value.
Okay, so it provides certainty for unique items.
Mm.
All these principles, contracts,
Mm.
they paint a picture of insurance being much more than just a policy document. What's its wider role in the economy, society?
Oh, it's huge. It spreads the cost of losses widely, so one person or business isn't devastated. It helps businesses operate by freeing up capital they'd otherwise have to hold back just in case. Premiums get invested back into the economy. Insurers often provide inspection services, reducing risks. They fund research. It promotes safety consciousness.
It really is a kind of bedrock then.
A vital one. An engine for stability and growth, often working quietly in the background.
So, wrapping this up,
Yeah.
what's the big takeaway for you? From those London coffee shops centuries ago to these complex rules today, insurance isn't just about paying claims. It's woven into economic stability, growth, our need to manage the unpredictable.
Absolutely. Understanding these foundations helps you see how it works, but also why it's so fundamental for, well, a secure society, which does make you think. With all the new risks emerging, digital threats, climate change, stuff like that, how will these core insurance principles need to change or adapt to keep protecting us effectively in the future?